Have you ever wondered what happens when two billionaires decide they can outsmart the entire global financial system? What if I told you that in 1980, three Texas oil heirs nearly brought down American banks, drove grandmothers to melt their silverware, and created a panic so severe that Congress had to investigate? And here's the really interesting part. We might be watching history repeat itself right now in 2025. Let me tell you a story about greed, leverage, and the day silver fell 50% in just 24 hours. The Hunt brothers weren't your typical investors. Nelson Bunker Hunt, William Herbert Hunt, and their younger brother Lamar inherited one of America's greatest oil fortunes from their father, H.L. Hunt, a Texas wildcatter whose wealth was legendary even by oil tycoon standards. When the old man died in 1974, he left behind an estate valued between $2 and $5 billion. That's real money, even by today's standards. But Bunker, the eldest of the three brothers involved in the silver scheme, wasn't interested in just sitting on his inheritance. He had apocalyptic anxieties. He genuinely believed that paper currency would become worthless, that inflation would spiral out of control, and that the American financial system was heading toward collapse. You have to remember the context here. The 1970s were brutal for the American economy. We're talking about gas lines stretching around blocks, the oil embargo, inflation hitting double digits, and a general sense that the world order was falling apart. In 1973, Colonel Muammar Gaddafi nationalized the Hunt brothers' Libyan oil fields. That event crystallized their fears. If a foreign dictator could just take your assets with the stroke of a pen, what good was any investment? They needed something real, something tangible, something that couldn't be confiscated or devalued by government decree. Gold was the obvious choice. There was just one problem. In 1933, President Franklin Roosevelt had prohibited U.S. citizens from owning gold. That ban wouldn't be lifted until 1974, right around the time the Hunts were looking for a safe haven. So they turned to silver. In the early 1970s, silver was trading at around $1.50 per ounce. It seemed ridiculously cheap to the brothers. They started buying quietly through various brokers and intermediaries. By 1974, the Hunt brothers collectively owned futures contracts on 55 million ounces of silver, representing about 9% of the world's private silver holdings. When these massive contracts reached expiration, the Hunts didn't do what normal commodity traders do. They didn't close out their positions for cash. Instead, they demanded physical delivery. They chartered 3 Boeing 707 aircraft, staffed them with armed Texas ranch hands, and flew the silver to vaults in Switzerland. This wasn't just an investment strategy. This was preparation for the apocalypse. For a few years after 1974, their silver holdings remained relatively stable. But in 1979, everything changed. In combination with partners from Saudi Arabia, including members of the Saudi royal family, the Hunt brothers organized another massive futures contract purchase for 43 million ounces, with delivery set for the fall of 1979. They were using enormous amounts of leverage, borrowing billions through margin accounts with brokers like Bache Halsey Stewart Shields, which would later become Prudential Bache Securities. Here's something most people don't understand about futures trading. When you buy on margin, you're essentially borrowing money from your broker to control a much larger position. It's like putting down 10% on a house, except instead of a house, you're controlling millions of ounces of silver, and instead of a 30-year mortgage, you might have to pay up in a few weeks if the market turns against you. By the end of 1979, the Hunt brothers were estimated to be holding over 100 million troy ounces of silver and several large silver futures contracts. They owned roughly 1/3 of the entire world supply of silver not held by governments. Their combined position, including both physical silver and futures contracts, was valued at approximately $4.5 billion, even though they had spent only about $1 billion of their own money. The rest was borrowed. What happened next was extraordinary. On January 1, 1979, silver opened at $6.08 per ounce based on the London fix. By January 18, 1980, Exactly 1 year and 17 days later, silver hit $49.45 per ounce. That's a 713% increase in just over a year. Intraday on COMEX, silver futures even touched $50.35. To put this in perspective, if you had bought $10,000 worth of silver on January 1st, 1979, and sold at the peak, you would have walked away with more than $81,000 in 1 year. The impact on everyday Americans was immediate and dramatic. Doctors struggled to afford X-ray film for patients because silver was a key component in photographic processing. Families started melting down their heirloom silver flatware to cash in on the high prices. Silver burglaries skyrocketed across the country. People were rifling through their dresser drawers and sofa cushions looking for old dimes and quarters that contained silver. The famous jewelry company Tiffany & Company took out a full-page advertisement in the New York Times. The ad, which ran on March 26, 1980, didn't name names, but everyone knew who they were talking about. It read, "We think it is unconscionable for anyone to hoard several billion, yes, billion dollars worth of silver, and thus drive the price up so high that others must pay artificially high prices for articles made of silver, from baby spoons to tea sets, as well as photographic film and other products." Tiffany was forced to drastically raise its jewelry prices. The British film producer Ilford had to lay off workers because they couldn't afford the silver needed for their film production. This wasn't just about commodity prices anymore. This was affecting real people's jobs and livelihoods. But here's the thing that makes this story more complicated than the simple narrative of greedy billionaires manipulating markets. Gold was also skyrocketing. On January 21, 1980, just 3 days after silver hit its peak, gold reached $850 per ounce, up from around $200 in early 1978. Platinum prices had quintupled. Palladium had gone up sixfold. Crude oil prices had quadrupled. The entire commodities market was going absolutely crazy. The second oil shock, triggered by events in Iran, had sent gasoline prices soaring again. Americans were once again waiting in long lines at gas stations. Inflation was out of control. The Federal Reserve, under new chairman Paul Volcker, was desperately trying to get a handle on the economy by raising interest rates. So, were the Hunt brothers really driving the silver market? Or were they just riding a wave of inflation panic that was sweeping through all commodities? That question would be debated for decades. By late 1979 and early 1980, it became clear to regulators that something had to be done. The commodity exchange in New York, known as COMEX, was facing a potential disaster. They only had about 120 million ounces of physical silver in reserve. That would normally be more than enough to cover standard trading and physical deliveries. But in October 1979 alone, that entire amount was traded. If all of the silver traders decided to take physical delivery of these futures contracts, the exchanges would be forced to buy silver on the open market, driving the price even higher and potentially causing the exchange itself to default. On January 7, 1980, COMEX made a drastic move. They adopted what became known as Silver Rule 7, which placed heavy restrictions on the purchase of commodities on margin. Specifically, the rule limited traders to holding or taking delivery of just 50 contracts in January and February, and 500 contracts per month in later months. The Chicago Board of Trade implemented similar restrictions. Think about what this meant. The exchanges essentially changed the rules in the middle of the game. If you were long silver, betting that prices would go higher, you suddenly couldn't buy anymore. You could only sell. It was liquidation orders only. The market was now rigged against anyone holding large, long positions, which meant it was rigged against the Hunt brothers. Then, on March 14, 1980, the Federal Reserve issued a directive that would prove devastating. They restricted bank lending to reduce speculative credit. Banks were specifically told to make it more difficult to finance massive speculative holdings of precious metals. The Hunts, who had borrowed heavily from American banks, suddenly found themselves in a desperate search for credit from European banks. But everyone knew they were in trouble. The credit dried up. What happened next became known as Silver Thursday, one of the most dramatic single-day collapses in financial market history. On March 27, 1980, silver opened at around $21.62 per ounce. By the end of the day, it had fallen to $10.80. The price had dropped 50% in a single day. In just 4 days, silver had lost more than half its value from its January peak. The Hunt brothers couldn't meet their margin calls. When you're trading on margin and the price moves against you, your broker requires you to deposit more money to cover potential losses. The Hunts were issued a margin call for $100 million from Batch alone. They couldn't pay it. Their paper profits had evaporated, and now they were facing real losses measured in the billions. Here's where it gets really scary for the financial system. The Hunts had borrowed from more than 20 different financial institutions. If they went bankrupt, they would take many of their lenders down with them. We're talking about some of the biggest names on Wall Street. The failure of the Hunt brothers didn't just threaten them personally. It threatened to punch a hole in the financial fabric of the United States. The situation was so dire that a consortium of U.S. banks, with approval from the Federal Reserve, had to put together an emergency rescue package. They provided a $1.1 line of credit to allow the brothers to pay Bache and their other creditors. Without this bailout, several major brokerage firms and banks might have collapsed. James Stone, who was the chairman of the Commodity Futures Trading Commission at the time, would later say that the Hunt brothers' actions had threatened to blast a hole in the financial system like nothing had since the Great Depression. Harper's Magazine, writing about the episode a year later, described Silver Thursday as the first great panic since October 1929. Think about that. This was being compared to the stock market crash that triggered the Great Depression. The Hunt brothers lost over $1 billion through this incident. In today's dollars, adjusted for inflation, that would be over $3.5 billion. Their estimated net worth fell from $5 billion in 1980 to less than $1 billion by 1988. But the financial losses were just the beginning of their problems. They faced congressional hearings. They were sued by multiple parties who had lost money in the crash. The Securities and Exchange Commission launched investigations. The Commodity Futures Trading Commission pursued civil charges. In August 1988, a federal jury ordered Nelson Bunker Hunt, William Herbert Hunt, and their brother Lamar to pay more than $130 million in damages to Minpico, a mineral marketing company of the Peruvian government that had been ruined by the silver manipulation. Shortly after, both Nelson Bunker and William Herbert filed for personal bankruptcy protection. In 1989, the brothers reached a settlement with the Commodity Futures Trading Commission. Each brother was ordered to pay fines of $10 million and was banned for life from trading in American commodity markets. This was in addition to multi-million-dollar settlements with the IRS for back taxes, fines, and interest. The bankruptcy proceedings revealed the scope of what they had lost. The IRS alone wanted $730 million from Bunker and $317 million from Herbert for back taxes and interest. Bunker's total debts topped $1.5 billion. Herbert's were almost $1.2 billion. They had to liquidate everything. In 1988, Bunker Hunt sold 580 thoroughbred horses at Keeneland Sales for $46,912,000. At that time, it was the highest amount in the history of thoroughbred auctions. Bunker, who had been worth an estimated $16 billion at his peak in the 1960s, emerged from bankruptcy with under $10 million to his name. He couldn't even maintain his 500-plus stable of horses. The oil bust of the early 1980s polished off what little remained of their fortune. When oil prices collapsed, the brothers lost their remaining source of wealth. They had pledged most of their oil assets as collateral for the rescue loan package. Here's where the story gets interesting, and why I wanted to tell you about all this in detail. Were the Hunt brothers really guilty of manipulating the silver market, or were they scapegoats for a commodity bubble that had many causes? The Hunt brothers always maintained they were innocent. They claimed they weren't trying to corner the market or manipulate prices. They argued they were simply hedging against inflation, and the declining value of the US dollar. The fact that they took physical delivery of their silver, rather than just trading paper contracts for profit, supports this argument to some extent. Some analysts have pointed out that at their peak, the Hunt brothers controlled only about 2% of the world's physical silver supply. Yes, they held a much larger percentage of futures contracts, but the actual metal they owned wasn't that different from what Warren Buffett would later accumulate between 1998 and 2006. Jeffrey Christian, a bullion market expert who directly covered the silver market during that period, reportedly believes that the Hunt brothers' actions only added about 75 cents to $1 per ounce to the silver price. Other economic studies have suggested the brothers were scapegoated, that they were convenient villains for a commodity inflation that had many causes. The Silver Institute, in their historical analysis, emphasizes that by 1979, investors and market participants had come to the strong conviction that the silver market was facing a severe shortage. The market had been living off of investor selling for 7 years. There were serious questions about how much longer investors would continue supplying silver to fabricators at the low prices of the mid-1970s. World economic and political events, including a major cyclical upward surge in inflation throughout the industrialized world, were putting pressure on silver prices. The retrospectives that focus only on the Hunt brothers' high-profile purchases miss the broader picture. There was a tremendously broad-based rush to buy silver by investors worldwide at that time. Everyone was scared about inflation. Everyone was looking for a safe haven. And let's not forget the timing of COMEX's rule changes. On Friday, January 18, 1980, silver and gold were hitting record highs. The following Monday, January 21st, COMEX suddenly announced drastic rule changes, essentially making it impossible to go long on silver. You could only place liquidation orders. This wasn't a normal market adjustment. This was a deliberate decision to force prices down. So were the Hunt brothers manipulators? Or were they investors who got caught on the wrong side of politically motivated rule changes? Reasonable people can disagree on this question. Now, let's talk about why this matters today. Because as I'm writing this in December 2025, silver is trading at around $67 per ounce, up approximately 130% year to date. That's the strongest annual gain for silver since, you guessed it, 1979. The silver market is experiencing its 5th consecutive year of supply deficit. According to multiple sources, including the Silver Institute and metals consultancy firms, the cumulative deficit from 2021 through 2024 has reached approximately 678 to 800 million ounces. That's equivalent to nearly 1 full year of global mine production. Let me repeat that because it's important. The world has consumed between 678 and 800 million more ounces of silver than it has produced over the past 4 years. Where is that silver coming from? It's coming from above-ground inventories, from stockpiles, from exchanges. And those inventories are running low. COMEX-registered silver stocks have declined 70% from their 2020 peaks. London Metal Exchange inventories are at historic lows. Silver lease rates, which typically hover around 1 to 2%, spiked to 7% in the first half of 2024. When borrowing costs jump that high, it's a clear sign of physical supply constraints. Industrial demand for silver hit a record 680.5 million ounces in 2024, marking the 4th consecutive year of record industrial demand. This isn't speculation. This is real, physical demand from manufacturers who need silver for solar panels, electronics, electric vehicles, and artificial intelligence applications. About 75 to 80% of silver production comes as a byproduct of mining other metals like copper, zinc, and lead. This means that even when silver prices rise dramatically, production can't easily increase. Miners don't just switch on new silver production. They're mining copper or zinc, and the silver comes along as a secondary product. So we have a situation where demand is growing structurally, supply is inelastic, and inventories are being drawn down year after year. Does any of this sound familiar? The difference between 1979 to 1980 and today is leverage. The Hunt brothers borrowed billions to control their silver position. When the market turned against them, they couldn't meet their margin calls, and everything collapsed. Today, there are certainly investors using leverage, but the overall market structure is different. Exchange-traded funds hold over 1 billion ounces of silver as of mid-2024. That's real metal, not leveraged paper positions. So what should collectors and investors take away from the Hunt brothers story? Let me break this down clearly. First, leverage kills. The Hunt brothers had billions in real wealth. They owned oil fields, real estate, thoroughbred horses, art collections, but they borrowed too much. And when the market turned, all of that real wealth couldn't save them. Were forced to liquidate everything. If they had bought silver with cash instead of margin, they could have held through the crash and still been fine. Physical assets owned outright can weather any storm. Second, markets can stay irrational longer than you can stay solvent. The Hunt brothers might have been right about inflation and the long-term value of silver. 45 years later, here we are with silver near all-time highs and a massive supply deficit. But being right in the long run doesn't help if you're forced to sell at the bottom. Third, when you become too big, you become a target. Whether the Hunt brothers were manipulating the market or just making a big bet, once they controlled such a large position, they had a target on their backs. Regulators changed the rules specifically to force them out. Right or wrong, fair or unfair, that's what happened. Fourth, physical is different from paper. The Hunt brothers insisted on taking physical delivery of their silver. That decision probably saved them from even worse losses, because at least they had real metal they could eventually sell. Paper positions can go to zero. Physical metal is always worth something. Fifth, supply and demand fundamentals matter, but they don't move in straight lines. The silver shortage of the late 1970s was real. The Hunt brothers weren't wrong about that. But prices can overshoot on the way up and crash violently on the way down before eventually finding equilibrium. Sixth, government intervention is always a possibility. If regulators think the market is getting out of hand, they can and will change the rules. COMEX changed margin requirements and trading rules specifically to stop the Hunt brothers. The Federal Reserve restricted lending specifically to target precious metal speculation. Never assume the rules will stay the same when money and power are at stake. I'm not going to tell you what to do with your money. I'm not giving investment advice. But I will share some facts that you should consider. Silver started 2025 at around $29.29 per ounce. As of mid-December 2025, it's trading around $67. That's a gain of approximately 130%. The metal briefly touched new all-time nominal highs above $66 in recent weeks. The supply deficit is projected to continue through 2025 and beyond. Industrial demand isn't going away. Solar panel installations are expanding globally. Electric vehicle production is growing. AI data centers need massive amounts of electronics, all of which contain silver. These are structural, long-term trends, not speculative bubbles. But remember, in 1980, silver went from $6 to $50 in a year, then crashed to under $11 in a matter of weeks. Just because the fundamentals support higher prices doesn't mean the price can't crash violently in the short term. If you're buying silver today, ask yourself, am I using leverage or am I buying with cash I can afford to hold long term? Am I prepared to ride out volatility? Do I understand that regulations could change? Am I buying physical metal or paper contracts? The Hunt brothers' story is ultimately about the dangers of leverage, the unpredictability of markets, and the importance of understanding that paper wealth isn't real until you cash out. They had billions on paper in January 1980. By March, they were bankrupt. That's how fast things can change. There's something almost tragic about the Hunt brothers' story. These weren't evil men trying to destroy the economy. Bunker Hunt genuinely believed that the financial system was headed for collapse. He was trying to protect his family's wealth in the only way that made sense to him. He wasn't entirely wrong either. Inflation was devastating in the 1970s, The dollar did lose significant purchasing power. His methods were flawed, but his fears were understandable. After losing everything, Bunker Hunt didn't give up on life. In 1999, at age 73, he returned to thoroughbred racing, spending just over $2 million on 51 horses. He showed up at Lone Star Park in Grand Prairie, Texas, wearing his trademark rumpled suit and black frame glasses. He was back doing what he loved, even if he could never do it on the scale he once had. William Herbert Hunt, Bunker's younger brother, passed away in 2024 at the age of 95, just months before silver would begin its latest historic run. One wonders what he thought, watching silver prices climb again after all those decades. The Hunt brothers accumulated over 100 million ounces of silver and borrowed billions to do it. Silver prices inflated 713% in just over a year, reaching an intraday high of $50.35 on January 18, 1980. By late 1979, the brothers controlled an estimated 70% of deliverable non-government silver supply. Federal investigations, COMEX rule changes, and Federal Reserve lending restrictions crushed their positions. Silver fell 90% over the next 2 years, dropping to around $4.90 by 1982. In 1988, the brothers were fined and ordered to pay over $130 million. They declared bankruptcy, with combined debts approaching $3 billion. Today, in 2025, with a 130% year-to-date rise and silver trading at $67, with a cumulative deficit approaching 800 million ounces, this Wild West story of debt and leverage reminds us of one critical lesson. Leverage kills, and physical assets held outright win. The silver market is fascinating, complex, and sometimes dangerous. Whether you're a collector, investor, or just someone interested in financial history, the Hunt brothers saga offers lessons that remain relevant more than 4 decades later. Markets can be manipulated. Rules can change overnight. Leverage magnifies both gains and losses. And sometimes, being right isn't enough. What we're seeing in the silver market today might be the beginning of another historic run. Or it might be setting up for another crash. Nobody knows for certain. But if you understand what happened in 1979 and 1980, you'll at least be prepared for whatever comes next. Stay informed, be cautious with leverage, and remember that history doesn't repeat, but it often rhymes. If you found this deep dive into silver market history valuable, please subscribe to our channel and leave a comment below. What do you think about today's silver market compared to the Hunt brothers era? Are we headed for another Silver Thursday? Or is this time truly different? Share your thoughts, and let's discuss the fascinating intersection of history, markets, and precious metals.